Kinesis $100, Pax G $5,400. While comics slept on the last video, I told you to watch the gap. I told you that if you ignored the weekend pricing action in physically backed crypto markets, you were going to miss exactly what you came here for. While Western spot markets were closed on Friday, silver closed at $93 and gold at $5,278. But that wasn't the real price discovery. Kinesis silver was trading near $100. Hyperliquid was printing $96. PXG gold was trading around $5,400. Those markets run all weekend. COMEX was asleep. Futures were closed. But physically backed digital markets kept trading. They were showing you the preview. But today isn't just about the gap. What happened after the gap is more important than the gap itself. $5,574 retail pricing. Investment bars sold out, $6,329 craft bars. While American markets were preparing to open, China was already deep into a full-scale physical gold buying stampede. China's largest e-commerce platform adjusted gold prices to the equivalent of $5,574 per ounce. Let that sink in. Western spot is trading around $5,346 as I'm recording this. But Chinese retail pricing surged far beyond that level, and then the physical supply started disappearing. Major physical gold stores across China stopped selling investment-grade gold bars entirely. They are now only offering craft gold bars, decorative pieces, priced at the equivalent of $6,329 per ounce. Western spot, $5,346. Chinese retail craft bars, $6,329. That's roughly a $1,000 premium. And not because of speculation, because they ran out of investment bars to sell. This is not a technical divergence. This is physical scarcity. In real time, in the largest gold-consuming nation on Earth. Then it escalated. Jingdong Finance, running gold accumulation products in partnership with Zheshang Bank on China's largest e-commerce platform, crashed when markets opened. Severe congestion. Users unable to log in, unable to purchase. China holds roughly 336 trillion yuan in savings. A meaningful portion of that tried to move into gold simultaneously. The system couldn't handle it. Every major Chinese bank reported a gold buying rush. Every major Chinese gold miner hit daily limit up. This isn't quiet accumulation. This is a stampede. And here's what Western investors should notice. Chinese miners are limit up. Western miners are not following yet. Historically, mining stocks amplify the move in the underlying metal, sometimes 3 to 5 times. That divergence right now between Eastern and Western mining equities is either a major opportunity or a warning. Now zoom out. This isn't just about safe haven flows. This is about regime change in markets. Iran has struck 15 different countries or military installations. Israel, United States, UAE, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, Cyprus, plus French, Italian, and British military positions. That's not a contained regional flare-up. That's a multi-front engagement hitting critical global energy infrastructure. Saudi Arabia's Ras Tanura refinery, the largest in the kingdom, processing 550,000 barrels per day, halted operations after a drone strike. At the same time, Iranian drones struck Qatar's Ras Laffan energy complex, one of the most critical LNG facilities in the world. Qatar accounts for roughly 18 to 20% of global liquefied natural gas supply. Production halted. The U.S. canceled 41% of scheduled Middle East flights. And the U.S. president publicly stated, "We haven't even started. The big one is coming soon." And oil is going down. Let that sit. 30% of global oil supply is impaired, and price is drifting lower from $73 to $70 after an initial 8 to 9% gap up. That is not fundamentals. That is positioning. When physical demand meets paper selling. Meanwhile, at the exact same time, China is experiencing the most aggressive physical gold buying stampede in years. Investment-grade bars sold out. Craft bars trading at $6,229, while Western spot sits at $5,246. Jingdong Finance's gold platform crashed from user congestion. Every major Chinese bank reporting a gold rush, every major Chinese gold miner limit up. European natural gas prices exploding 47%. Saudi Arabia's largest refinery offline. Qatar's LNG production halted. 30% of global oil supply disrupted. And then you sell into the gap to take profit, or you cover shorts into the panic bid. That is exactly what the oil price action looks like. Gap higher on the event. And if oil is being managed through positioning despite a 30% supply disruption, what do you think is happening in precious metals, where the paper-to-physical leverage is even more extreme? Chinese miners versus Western miners. Opportunity or warning? Here's another signal that deserves attention. Every major Chinese gold miner hit daily limit up during the stampede. These are the companies that produce the metal. When physical demand surges and retail pricing in China is at $5,574 to $6,229 per ounce, the miners benefit directly because their production becomes more valuable and their margins expand. They are up, yes, but they are not tracking the same magnitude of move that we are seeing in Chinese mining equities. Historically, mining stocks amplify the move in the underlying metal by a factor of 3 to 5 times. When gold rises 10%, miners often rise 30 to 50% because of operational leverage. But right now, we are seeing Chinese miners limit up while Western miners lag. That divergence is significant. It could represent a major opportunity. Western miners have not yet priced in the full extent of what is happening in the physical market. And when they catch up, the move could be explosive. Or it could be a warning. Western institutional money is not yet convinced that this move is sustainable, and they are waiting to see whether the geopolitical situation escalates further, or whether cooler heads prevail and the situation de-escalates. Either way, the divergence between Eastern and Western mining equities is a signal that the market is not yet unified in its assessment of where this is going. And when you have that kind of divergence, you get volatility, which is exactly what we are seeing. Physical demand versus paper supply. The battle continues. So what does the $97 to $90 reversal in silver actually tell you? It tells you that the paper market still has the ability to absorb physical demand shocks and reverse price action in the short term. The gap up from $93 to $97 was real. The weekend premiums were real. The Chinese buying stampede is real. The geopolitical supply disruption is real. But the paper market's ability to sell aggressively into that move and push price back down to $90 is also real. This is the core tension in precious metals markets right now. Physical demand is at extreme levels. Chinese retail buyers are paying $1,000 premiums over Western spot. Investment-grade bars are sold out. Jingdong Finance crashed from user congestion. Central banks continue to accumulate. Industrial demand for silver remains structurally strong. The question is, for how long? Every time Chinese buyers pay $6,329 for gold bars, while Western spot quotes $5,946, the gap between physical reality and paper pricing becomes more visible. And every time 30% of global oil supply goes offline and price still reverses lower, more traders start asking whether the market is actually functioning or whether it is being managed. The reversal from $97 to $90 does not invalidate the bull case. It just confirms that the transition from paper-dominated pricing to physical-dominated pricing is not going to be smooth, it is going to be volatile, it is going to be contested, and it is going to require physical demand to overwhelm paper supply so decisively that the paper market can no longer absorb it. Chinese premiums, geopolitical escalation, and minor divergence. So what do you watch right now to understand whether this is just another volatility spike that gets absorbed, or whether this is the beginning of a sustained breakout that the paper market cannot contain? If Chinese retail gold pricing remains at $5,974 to $6,929, while Western spot sits at $5,346, that $1,000 premium is unsustainable. Eventually, arbitrage forces will either pull Western prices higher to close the gap, or Chinese demand will exhaust itself and premiums will compress. Watch which one happens. The US president said, "We haven't even started. The big one is coming soon." If strikes intensify, if more energy infrastructure goes offline, if the Strait of Hormuz closes entirely, Chinese miners are limit up. If Western miners start catching up and amplifying the move in the underlying metals, it signals that Western institutional money is starting to position for a sustained move higher. If they continue to lag, it suggests caution. Fourth, oil price stability. If oil can hold above $70 despite 30% of supply being offline, it confirms that the energy shock is real and sustained. If oil continues drifting lower, it suggests that positioning unwinds are overwhelming fundamentals. Fifth, COMEX inventory and open interest. Watch whether registered silver and gold inventory continues to decline, and whether open interest falls while price rises. Falling open interest with rising price signals delivery stress and paper market weakness. The battle between physical reality and paper control. Here is what we know. Silver gapped from 93 to nearly 97. Meanwhile, China experienced the most aggressive physical gold buying stampede in years. Investment-grade bars sold out. Craft bars trading at $6,229, while Western spot sits at $5,346. Jingdong Finance crashed from user congestion. Every major Chinese bank reported a gold rush. Every major Chinese gold miner limit up. European natural gas exploded 47%. Saudi Arabia's largest refinery offline. Qatar LNG halted. 30% of global oil supply disrupted. And oil dropped from $73 to $70. War, oil supply disruption, and Chinese physical demand all said prices should go up. Someone with control over paper positioning said they should go down, and for now, the paper market won the battle. But the war is not over, the fundamentals have not changed, the geopolitical risks have not diminished, the Chinese buying stampede has not stopped, the physical premiums have not compressed, and the gap between what physical metal costs in China and what paper contracts trade for in the West has never been wider. The $97 to $90 reversal is not the end of the story, it is a chapter. It is confirmation that the transition from paper control to physical price discovery is going to be contested, volatile, and violent. But it is also confirmation that physical demand is real, that Eastern buyers are willing to pay massive premiums, and that Western paper markets are struggling to contain the pressure. Watch the Chinese premiums. Watch the geopolitical escalation. Watch the mining stock divergence. Watch whether oil can hold above $78. And understand that in a world where 30% of oil supply goes offline and price still drops, and where Chinese buyers pay $6,320 for gold, while Western spot quotes $5,346, the market you are watching is not the market that is setting the real price. The real price is being set in physical markets, and eventually paper will have to follow.